Dean and Tyler Listle are registered investment advisor representatives. Investment advisory services offered through Brokers International Financial Services, LLC, member SIPC. Brokers International Financial Services, LLC, and Secure Retirement Solutions, LLC are not affiliated companies.
It's time for Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. Now, here are your hosts, Dean and Tyler.
Good morning, and thank you for joining us today. Tyler and I will discuss topics that affect your retirement, such as investments, income planning, Social Security, and much more. Good morning, Tyler. How are you?
Good morning, Dean. I'm doing great. How about yourself?
Good, thank you. Today we're going to talk about mutual fund basics. We had a good time putting together the information for today's topic because it seems to be mutual funds are recognized by most investors. Whether you're just starting, whether you are an advanced investor, people are familiar with mutual funds. They're carried in most plans that you have at work through a 401k or a pension or a 403b. So again, people are very familiar with them. But when you get right down to it, a lot of people don't understand how they work. And in some situations, mutual funds might be better served in different portfolios than others. So today we're going to talk about mutual fund basics, try to make it easier for you to make a decision when you invest in mutual funds or to be able to ask questions of your investment advisor. So Tyler, let's just talk about the basic. What really is a mutual fund?
Yeah, Dean, so when we talk about mutual fund basics today, the first thing to get into is what is a mutual fund. And with that said, in the most basic terms, a mutual fund is a bunch of different stocks all in one based on a certain investment objective. So a mutual fund might hold 50 to 100 to even 200 or more individual stocks and or bonds, and it's based on a certain objective. Now, those stocks are then managed by a mutual fund manager. So you give control over to the mutual fund manager, and they buy or sell the different stocks or bonds based on the fund's investment objective. Now, what I mean by that, we're going to get into that a little bit here in the show. But when we talk about an investment objective, that might be, for example, growth or income or growth and income. But again, we're going to get into those in a little bit here. The other thing about mutual funds is they usually have internal fees. Now, they usually have internal fees because there is a mutual fund manager that buys and sells different positions, so they get compensated for it through various internal mutual fund fees. Now, if you went and created a portfolio on your own of different individual stocks, you would most likely only pay a fee to buy and sell those stocks because you're managing it yourself. Now, again, with a mutual fund, you hand over that management to the fund manager, and that's where the internal fees come in. Another thing with mutual fund basics is that it helps, or different mutual funds, they help offset downside due to diversification. And what I mean by that is with mutual funds, with having those 100 to 200 or more individual stocks and or bonds all into one, that helps offset your downside, because if you only are holding one or two different stocks, then you're going to take on the full downside if those stocks or those particular sectors go down. And we see this a lot in different companies where employees might have company stock option available to them within their 401k, or they might have a profit sharing plan. And I've seen it before where there are employees that they put over half of their retirement account in their company stock for various reasons. However, when they do that, they don't have a whole lot of downside protection, because if their company starts going down, then that particular stock is going to go down, and that's really going to hurt their overall retirement account. So again, with having a lot in, or various amounts in mutual funds, that's going to offset that downside risk due to the diversification.
Okay, and there's something else here, Tyler, I just thought of, and that is, for instance, with mutual funds too, you can buy partial shares. And that's important to know, because there are a lot of people that want to get started or have portfolios, and they want to buy maybe certain stocks in their portfolios. You have to buy whole shares of stock. So if you want to buy an Amazon stock, you're going to pay $1,400 to $1,900 depending on what the market value is at that time. Whereas if you want to get started with an investment portfolio, you can put $100 or $250 into an account and buy a certain amount of mutual funds with that. So you can buy, quote, dollars worth of mutual funds, whereas stock, you have to buy whole shares. So that's another thing that differentiates mutual funds from individual stocks. And again, as I said earlier, it's not only for beginners. We see people, very advanced investors carrying mutual funds, though it seems to be as you get older and more experienced with investing, you typically look at and scrutinize your investments a little bit more. Whereas you'll see mutual funds, people will scrutinize some of the internal fees a little bit more. And quite honestly, all of that is available to everybody out there. 20 years ago, you really had to do a lot of research to find out internal fees and rates of return and turnover. Turnover is the term of how often they sell individual stocks out of the mutual fund. That was hard to find. You had to gather that information from a multitude of places. Right now, you can go to Yahoo Finance, you can go to Morningstar. There are so many good resources out there that you can find everything that you could possibly want in a mutual fund profile. Anything else there, Tyler?
One more thing that I wanted to point out when it comes to mutual fund basics and what is a mutual fund. Again, the reason why many people know about mutual funds and they're familiar with them is because they're the primary investment that's used in corporate-sponsored retirement plans. So if you have a 401k, a 403b, a 457, a profit-sharing plan, more likely than not, you probably have different mutual funds to choose from within that plan. And again, that's how, over time, that's how your account makes money based on the different mutual funds that you choose. But again, mutual funds, they're one of the most popular investments out there when it comes to saving in general, saving for retirement, because they are in many different corporate sponsored plans. But again, when it comes to just the basics of what is a mutual fund, I look at it as 50 to 100 to even more individual stocks, all in one portfolio based on a certain investment objective.
Okay, now let's talk about types of mutual funds. There are all different types of mutual funds out there. You don't just go buy one mutual fund that's good for everybody. It's based on your risk, your time horizon, your liquidity needs, when you're going to need the money. So what you do when you look at mutual funds, there are things such as balanced funds, there are income funds, there are growth and income, growth, international, and sector specific. And we'll talk about those a little bit. But I'm going to start out with balanced right now. We tend to see a lot of people carrying balanced funds, which is nice because, again, the internal manager, the manager who is buying and selling within the mutual fund, typically has a balance. So, for instance, based on your risk tolerance, there's a certain balance fund you might get where it has 70% of equity, which is stock positions, and then maybe 30% bond positions. However, don't just accept the fact that you have a balanced fund and it's going to help you specifically for market downturn or to pick up a gain. Look at it a little bit more. If you're working with an investment advisor, ask what the balanced fund is made up of. We see a lot of balanced funds that the side that is considered bonds, they're holding very long-term bonds, which quite honestly are some of the riskiest bonds you can have. So look at them. There might be some balanced funds that are carrying shorter-term bond positions, which we actually prefer in today's marketplace. But, there are a lot of different type of bonds that can be held in balance. There can be long-term, there can be short-term, corporate, high yield. High yield are referred to junk bonds. They're very risky. So don't just accept the fact that you have bonds for protection and you have equity positions for growth. Scrutinize them a little bit more. And that also holds true with target date funds. We see a lot of those out there. Those are the mutual funds that have a date to them. So as an example, it's a retirement date 2020. And what that would mean is if you anticipate retiring at 2020, this would be a good all-encompassing mutual fund for you because it's skewed very heavy towards the conservative side, which would be bonds. And then it does carry a small amount of equity positions, which would be your stocks. However, I have seen target date funds that carry really two main investment objectives there. One is a bond position, which could be long-term bonds. And then on the equity side, they're carrying substantial international positions. Well, neither of those two are doing very well right now. International is not doing well based on tariffs, and bond positions, based on interest rates and just they had been stressed for the last couple of years, especially long-term bonds. So it's probably not a real good hold for most people. So scrutinize them a little bit. Go on to Yahoo Finance, Morningstar, anything else. I'm not endorsing those two, but those are the two that are readily available. And they have really good reports that you can see for everybody out there, not just investment advisors. Tyler, what about some of the others like income growth and so on?
Yeah, Dean, so balance is one of them. One of the more popular ones. A couple other ones would be income. And when you hear about an income mutual fund, that is typically a mutual fund comprised of various bonds like you spoke about, Dean. Those are typically utilized by pre-retirees and retirees who are looking to draw income from their portfolio. Now with different income mutual funds, again, they're used, just like the term implies, they're used for income. You're usually not going to see the same growth out of those as you will for your growth-oriented mutual funds that are containing only stocks. So again, it's something that is a bit more conservative. Definitely, they can still lose value, like we're seeing right now. Different bonds that historically haven't been as volatile as they are now, especially long-term bonds, they can be down anywhere from 4 to 6% depending on the market. But again, income mutual funds are made of bonds, which are more conservative. They pay out income, and then you have growth and income, which growth and income can be used within a portfolio for different types of stocks and bonds. Usually when you hear of growth and income, they're referring to more so dividend-paying stock funds because it's growth-oriented because it has stocks in it, but then the income side actually comes from the dividends that the stocks pay out. So growth and income is usually made up of different dividend-paying stocks, maybe some bonds in there as well. And then going on down the list, we also have growth mutual funds as well. Now, just like the name implies here, growth mutual funds are primarily used for growth potential. Usually what you'll see within those are various types of growth stocks where over time the main objective is to grow your account as much as possible. With a growth mutual fund, it's going to be more volatile. You have to be willing to accept more risk in exchange for higher return. And then also there's different types of international and sector-specific mutual funds. International mutual funds, they will invest in various stocks of companies that are based internationally. Be sure, again, when it comes to international, they're going to be more volatile as well. So be sure that you're willing and able to handle that risk of international mutual fund investing. It's something that's going to fluctuate based on the international market. Right now, the international market is not doing too well. Same thing with 2018. It was down anywhere from 10 to 15%. However, in 2017, international stocks were up, over 20%. So again, it's something that's really going to fluctuate based on the economy and the overall international market. And then different sector-specific mutual funds, for example, you might have healthcare, technology, there's biotechnology, there's a bunch of different sectors that you can go into, semiconductors. So if you want to get certain exposure to a particular sector, there's different mutual funds that will only invest in healthcare stocks or technology stocks or internet stocks, different things like that. So as you can see here, we just listed off a bunch of different types of mutual funds based on their objective sector, the different holdings within them. So there's a multitude of different mutual funds that you can choose from.
Okay. Now, so we were talking about, the types of mutual funds, but there's also classes of mutual funds. And what I mean by that is you might have heard somebody refer to A shares, okay, or C shares or I shares. What they mean by that is a classification of how fees are charged with mutual funds. You'd like to think that mutual funds are free, there's no expense to them, but there is an expense to them. And it's based on the share price that is out there, whether it's A, C, I. There's many others, but we'll look at those. And typically, people refer to A shares as retail shares, meaning that those are most readily available to people who want to self-manage their own accounts, or many investment firms that put together portfolios for those people just starting with mutual funds. So Tyler, let's talk about A shares, C shares, and I shares and how those expenses are charged to the investor.
Yeah, Dean, so when it comes to mutual funds, there are different share classes. And with that, share classes they determine the different fees that come out of the mutual fund. So like you said, A shares are one of the most common ones. with an A share, you are charged a front-end load. So, for example, what that means is if you were to put $1,000, if you were to invest $1,000 into a mutual fund, they would charge, it's all dependent upon the mutual fund company, but some might charge a 5% front-end load, others might be 5.75, others might be 4%. So when you put money in, they will take 5%, for example, off the front end. That is a commission that goes to either the advisor that put you into there and or the mutual fund company. So with A shares, you pay a higher percentage on the front end, but then you have lower internal fees that go to the fund manager thereafter. The other very common one are C shares. C shares are typically meant for if you're holding a fund for a shorter term, because you don't pay that front end load, but there's a higher internal fee. And usually if you were to sell off a mutual fund within a year of buying it, you also have a back-end load where they might take 1%. You might have to pay a 1% commission if you sell the fund less than a year. So C shares, you don't pay that front-end load, but they do have higher internal fees. And then another more common or more popular one would be I shares or R shares, and those stand for institutional or retirement shares, and usually those are used within different types of employer-sponsored plans. They have lower internal fees because within a 401k, a 403b, you are paying different administrative fees on top of that, different service fees. So usually the mutual fund fees are lower there, but they have internal fees there as well within an institutional share and an R share or a retirement share. So those are some of the main share classes. And again, share classes determine when the fee comes out that you pay, and the difference in a front-end load, back-end load, or just simply internal fees. So again, be aware that whenever you are looking to buy into different mutual funds, they do have different share classes, and that's something really important to pay attention to because the share classes, again, they determine the different fee that you're going to pay.
Okay, before we continue with share classes, we're going to take a quick break.
You're listening to Dean and Tyler Listle, investment advisors with Secure Retirement Solutions located on Allied Street in Green Bay. For a complimentary review of your current investments, or if you have questions, please call them at 920-347-9888 or go to their website at srsplans.com.
Okay, let's talk a little bit more about those share classes. Tyler, for instance, an A share, we hear from clients, they'll come in and they'll show us their portfolio, and they're carrying A shares that they've had for a number of years, and they might not have added anything else to this. They just have dividends being reinvested. And when you explain to them that an A share is a commissionable investment that their advisor put them into, many times they feel slighted. They don't like the idea that they paid a 5% commission. They feel that's excessive. Well, in certain situations it is, especially if you don't plan on keeping the investment real long. Paying a substantial commission on the front end can be excessive. However, if somebody is carrying that investment for a number of years, 10 or 15 years, it's actually very efficient because they paid the one-time commission that their advisor or the bank had charged them, and they have no more fee of a commission thereafter. So sometimes you have to look at it and say, okay, it depends on how long you're going to carry it. Same thing with C shares. You know, you don't hear as much of them anymore, but in what situation would a C share be good for an investor, Tyler?
Yes, like I said, C shares, they're usually good for investors that want to hold them for a shorter period of time. So if there's someone that comes in and they say, you know, I have $10,000 or $20,000 and I want to save for a new house that I want to buy in, 5 years, or if I want to save for a wedding, or if I'm going to use it for retirement, but I might want to start withdrawing it down pretty heavily within the next 3 to 5 years. Usually C shares are going to be the better bet where you're not going to hold them for a long, long time horizon, whereas A shares, like you had mentioned, Dean, over the long term, they're going to be more efficient than C shares. So if someone is investing for retirement, you're going to hold them for 15, 20, 30, 40, even 50 years. Usually A shares are going to be the better route to go there. The other thing that I forgot to mention that I want to mention now with A shares is there's something called breakpoints. And breakpoints is where that front-end load, that front-end commission, it goes down with the higher dollar value that you invest. So what I mean by that is Going back to my 5% example, if you invest anywhere from $0 to $25,000 in a mutual fund, there might be a 5% front end load. Well, if you invest anywhere from $25,001 to $50,000, it might go down to 4.5%. If you go from $50,000 to $100,000, it might go down to 4% or 3%, and so on. So, what A shares do is they reward you essentially they encourage you to invest more by having a lower break point or a lower front end load with the more you invest. So again, if you invest more, you're going to pay a lower front end sales charge, whereas if you invest a lesser amount, it's probably going to be the highest possible front end load or front end commission that you're going to pay within an A share.
Okay, good points. Now, some people ask us, are mutual funds better served in certain portfolios? So, for instance, if they hold an IRA, are mutual funds better served there? Or if they have a non-qualified or an individual account, or we call them a non-retirement account, are they better served there? First of all, the bottom line is we just like the idea that you're investing. That's number one. Okay, get investing, and we can progress as you go through stages, whether you're getting close to retirement or you're younger and just accumulating wealth. But remember, an IRA is a tax-deferred vehicle. In other words, you put your investments, whether they're mutual funds or stocks or ETFs, into an IRA. In a traditional IRA, they're tax-deferred. You pay no taxes on them. You don't pay those fees that are charged by the mutual fund. What happens, though, when you do decide to withdraw from the IRA? Then you will start paying taxes at that particular time. A Roth works the same way in that they're tax deferred. It's actually tax free. So when you take the money out, you pay no taxes then too. But on an individual account, these are accounts that are non-retirement accounts. Somebody might have just started with savings. They had maybe an inheritance. They sold some property, so they wanted to invest. But they don't necessarily want to hold it until they're 60 or 59 and a half, which is what the IRS considers, retirement age. They might want to hold it for 10 years or so, or hold it to buy a house and be able to withdraw money from it to pay for the kids' education without having to keep it again until 59 and a half. Tyler, in that situation, again, what do you have to be aware of when it comes to mutual funds in that type of an account?
Yeah, Dean, good point there. When it comes to a non-qualified or a non-retirement account, as we refer to it, one thing to watch out for with mutual funds is something called capital gains. So what that means is with a non-qualified or non-retirement account, every single year you pay taxes on dividends, interest, or capital gains, even if you don't take them as income, even if they're reinvested. So it's considered a taxable account because every year you get a 1099 and you're taxed on that. Now with a mutual fund, they can sometimes be tax inefficient because every year that mutual fund manager, they buy and sell different stocks, and when they sell stocks, that generates a capital gain. And then every year, you're taxed on that capital gain. So you don't necessarily have control over your taxes and the different capital gains when it comes to mutual funds in a taxable account like a non-qualified account. Something that might be more efficient for tax purposes would be individual stocks or exchange-traded funds, because you can determine with individual stocks, for example, when you want to buy and sell them based on tax purposes, where again with a mutual fund, remember you have that mutual fund manager. They're the one who makes all those decisions on when to buy and sell stocks, and with them making those decisions, you're the one that then takes on that capital gain. So again, mutual funds are usually more efficient from a tax standpoint in qualified accounts. So again, those would be any type of retirement plans through work, traditional IRAs, Roth IRAs. Then they can definitely still be used in non-qualified or non-retirement accounts, but typically individual stocks and or exchange-traded funds are going to be more efficient from a tax standpoint in different non-qualified accounts.
Right. And one other point there I was just thinking about, Tyler, we tend to see this a lot. People will come in and they have to really watch their income. They might be retired or working part-time, but they have to watch their income because they are getting health insurance through the Affordable Care Act. And for those of you who don't know, the Affordable Care Act health insurance premiums are based on income, no longer based on pre-existing conditions. It's based on income. So what happens is they look at their income, they say, okay, I've got a part-time job, here's how much income I anticipate. I have Social Security, this is how much I anticipate. I might have some money coming from my IRA and it's taxed at that point. That shows as income. But they tend to forget that interest that they've gained on cash positions at the bank or capital gains that are charged to them on their non-qualified investment because the mutual funds are selling off at the end of the year. They're not aware of that, and sometimes it puts them into a situation where they report a certain income which isn't the case. It might be more as a result of those capital gains in a non-qualified account. So as Tyler said, many times we look at that and say, okay, is there more efficiency that we can have by replacing some of those mutual funds in that non-retirement account with exchange-traded funds or some single stocks?
Yeah, good point there, Dean. The last thing that I wanted to get to real quick that I think our listeners out there are going to benefit from are just the pros and cons to mutual funds. Now, it's kind of wrapping everything up here, but a lot of the pros that we went over would be active management. So again, you have a mutual fund manager that buys and sells different stocks for you, so that way you don't have to worry about that. Diversification as well. Within one mutual fund, you have access to 50 to 100 to 200 plus different individual stocks and or bonds. And mutual funds are also versatile. There's many different types like we went over. Again, you have the balance, the growth, the international growth and income, and different share classes as well. So you definitely have a wide variety to choose from. So those are the pros. Just a couple of cons here. You don't have control over the individual holdings. So if you really like Amazon stock, for example, well, then you need to go and hunt down a mutual fund that contains Amazon stock. And if that mutual fund manager sells it, then you no longer have it. So again, you don't have control over the individual stocks that are within the mutual fund. And if that's something that you want, then you might be better off just going out and buying individual stocks on your own. The other thing, as I just mentioned a little while ago, mutual funds can also be tax inefficient in non-qualified portfolios due to the capital gains. Again, that's when the mutual fund manager buys and sells different stocks. If they sell a stock, you take on that capital gain and you have to record that for tax purposes. Even if you don't know what's going on, even if you don't know that they sold it, you're going to get that tax document. You're going to have to record that for taxes. So again, they can be slightly tax inefficient in non-qualified portfolios. And then lastly, high fees are also a possibility where there's different mutual funds that charge higher fees. So again, always pay attention to the fees. Like Dean said, you can find that out on Yahoo Finance, Morningstar. Just going online and Googling the ticker symbol, you can find out all that fee information. So again, beware of the fees that you're being charged. And then over-diversification would be the last one, where over-diversification is if you have a bunch of different mutual funds, you want to make sure that they don't have all the same holdings. This is a common mistake that we see with people where they might have 5 different mutual funds and all 5 have the same top 10 holdings. So again, something to be aware of. But I think our listeners will really find this helpful going over basics of mutual funds, because mutual funds, like we said earlier, are one of the most common investment vehicles available to them out there.
Okay, good show, Tyler. That's all the time we have this week. See you later, and hope you'll join us again next week.
We'll see you next week.
You've been listening to Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. To get more information from Dean and Tyler, contact them at Secure Retirement Solutions on Allied Street in Green Bay. Call 920-347-9888 or visit them at srsplans.com. Securities and investment advisory services offered through Brokers International Financial Services, LLC. Member SIPC. Brokers International Financial Services is not an affiliated company.